Graham said that he thinks selling covered calls is the dumbest thing ever. What are your words on this?
I said it was pretty dumb.
He says selling covered calls is pretty dumb. Can we just
a broad statement? I mean, how far out of the money? I mean, what are you? There's so many. What stock? I mean, there's so many variables here.
Like very little out of the money, but within like a month, 2 months, give or take.
How is that dumb?
Because you're picking up pennies at the expense of the long-term stock market growing, and there's no such thing as free money.
That was my question.
Yeah.
Whenever someone asks us, well, what do you think about this? I always default back to why. Okay, selling covered calls. Why do you want to sell covered calls?
I would say there are certain stocks that I'm like hesitant on buying. For example, let's just say Chris Camillo says you should buy Bloom Energy.
Okay.
I'm like, well, I don't necessarily want to do all of the due diligence into why I should buy Bloom Energy, but maybe I would like to have the appreciation of this Bloom Energy. And so I go and I buy 100 shares of Bloom Energy, but the only way I justify myself to buy this 100 shares is because, let's say, I can get 3.5% per week on weekly call options if I want to sell covered calls. That's a good enough hedge where, hey, look, if it does end up going down, do I think it's going to go down on average more than 3.5%? It could. Could have gone less than 3.5%? It could, but still I have some appreciation of a stock that he told me I should buy. I get to watch it. I get to be more like involved with the
okay, so let's play the other side of it. You do it. You buy the Bloom Energy and you're selling this. And then Bloom does some exciting stuff. And it takes off.
And
right?
It did.
And it just...
It's $300 now.
And your position, it gets called away.
Would you buy it?
Well, I bought it kind of all over the place, but let's just say like my average. I don't know why he's laughing because I made more money on Bloom Energy than him. So you go ahead and keep laughing, buddy.
But let's say that it gets called away.
Yeah,
right.
It did.
For forever, you're going to be sitting in that position where you're like, man,
y'all are just like we are. That's hilarious. Y'all totally pick on each other.
It's insane that he's laughing because I made more on Bloom Energy than
you make on Bloom Energy.
Dude, I'm up like 26 grand right now on my 200 shares I'm holding.
I'm up more than that.
Oh yeah, you're up like 60 grand.
But y'all are making my point from something I said earlier. Do you want a sports fish or are you trying to feed the family? Because y'all are
I'm up way more than that.
Y'all are no different than two buddies who go out fishing so you can tell fishing stories on the fish that you almost caught and it got away. Whereas I'm telling you, there's a huge difference between investing versus speculating. Some of this stuff, this is speculative.
It's hardly. I mean, sure, because you're trying to, but you're making money off of time, which is what you're doing with invest.
But
you're not. Explain that. Explain theta decay, please. Explain that.
Jack doesn't understand that when he buys a stock, there is a risk that it goes down. Mm-hmm. So if he's making 3% in a week, it could very well go down 6% in a week, and he's net negative.
I don't understand
when accounting.
I absolutely do. Your position is more bullish than my position because mine is actually a hedge against the position.
And that's why I'm up so much.
But you were speculating more than I was.
No.
Yes, you were.
I bought in cheaper.
So one of the questions I'd be asking is like, okay, what's the thing?
I'll show you my
What's
loss.
The thing you're trying to accomplish here? What's the goal you're trying to achieve? What do you want your money to be doing for you? In the instance that you're describing, that would not be one that screams to me, ooh, selling covered calls makes a lot of sense. Where a covered call position might make sense is if you're executive who has a highly concentrated stock position and you want to figure out a way, okay, I can't sell this position because of embedded gains. Perhaps I'm going to do some sort of strategy where I want to protect my downside, but I also want to recoup some premium on the upside to cover the cost of the put. Something like that. You're in your scenario, if I was trying to just make a little bit more money on it and I was, bullish on it, I would maybe just buy a different stock that would do something differently. Because I agree with you, just because you can make some money doing something, oftentimes doesn't mean it makes a lot of sense. You can go walk around the freeway and pick up cans, and you can bag up all those cans. You can spend a couple hours doing that. You can take them in and trade them in and get the recycling money for that. But is that a good use of the time, and was that a good use of mental calories?
I don't think it's all worth the hassle factor. Because look, I've had this has happened to me so many times in my decades of investing. Like I'll meet a neighbor and they'll find out he's over here calculating returns. I've had a neighbor find out I'm a financial advisor, and they're like, "What stock do you recommend?" And then they're talking to me whether at the time it's Fitbit or whatever the latest greatest thing is. And then what's always funny is I tell them once they get to know me, I'm like, I buy index funds. I mean, that's what I actually do with my money is I buy index funds. And what's funny is I watch the education is after we get to be friends and 5 years in the future, they go, I started looking at my annual return of all the trading I was doing in individual stocks. And then I started looking at what I was making on just the total market return or the total market or the S&P 500 index. And I think I'm making more money on the S&P 500 or whatever. And I'm like, yeah, it's amazing. And you didn't have to stress out and and think about everything that was going on, that's the reality I try to share with people. Because even if you, and let me play devil's advocate, because even if you weren't selling the covered call where you got it taken away from you, if it shoots up, I've experienced, because I even have a story back in 2008, I called all my buddies and I was like, look, Apple stock right now is trading at a price that is the equivalent of what their physical assets. I'm not talking about the actual IP and intellectual property. I'm talking about the campus and other things. Wow. This stock has been beat up so bad. I was like, this is the biggest no-brainer. We should buy some Apple stock. So me and some buddies, because I don't buy a lot of individual stocks. I'm an index investor. We bought Apple stock. And let me ask you, this stock you bought, would you have sold it if it was up 200, 300, 400%? Or would you have taken your money?
Probably not.
You would have kept it? You would have just rolled forever?
I honestly
ride or die.
Have never really sold stocks. The only thing I've ever sold really.
So you have permanent portfolio on everything?
Except for
Dogecoin.
Except for Robinhood,
because that was a different thing.
You're the type, Jack, you're the prospect that we would get. I want to get back. Don't let me get off topic on
Martin called $10 a share for Robinhood.
Yeah.
Wow.
Jack, it would be the prospect that comes to us, and it looks like a quilt of his life. It's the quilt of Jack's wonderful life, because you can see what he was doing in every decade of his life.
3.5%.
3.5%. Guess what time?
How long?
This is 1 week. If you sell a call 25 cents out of the money on Robinhood weekly calls, you can get 3.5%. This is just linear growth, not even counting compound interest.
What price
times 52. This is 185% return on Robinhood over the course of a year.
What price did your balloon get called away at?
It got called away at a few different prices. I mean, just like I had quite a few different
options. That's why
it was like 88, 92, 94. I was making money on all of it.
What's it trading for now?
$280.
I would argue that the long position you missed out on did not compensate for the ROI you got in the covered calls, right? Like had you held it,
but I'm not observing. I'm just observing it in terms of what is the growth expressed as a percentage.
Sure.
And so and also I had 200 shares because guess what? It started going up and I had 200 shares that didn't get called away from me. I'm like, you know what? I'm just going to ride it out. And I did. And now it's at 200 and whatever dollars. No. And so I'm just saying a company as solvent as Robinhood, do you think that it's going to zero in the next year?
I haven't looked at their financials. I wouldn't.
Probably not.
I wouldn't.
Probably not. I met Vlad Tenev. We had him on the podcast, the CEO, founder of the company. Everything seems totally great. Love the company. Have used the app. Like I invest on the app. It's phenomenal. And so why, if the company doesn't go to zero, assuming that premiums stay the same, right? You'll get 185% return in a year.
But is this the best use of your time? This is the point.
For me, is it the best use of his time to be hunting for a coffee that's $1 cheaper? Right?
It's the hunt.
Right. Is it the best use of your time to buy 5 of those shirts because they give you at checkout an additional 5% off when you add other things? But we were talking about that before the episode.
Let me bring it back to why I don't love individual stocks.
Life insurance is one of those things that makes sense for a lot of people out there, but most people just put it off because it feels complicated, expensive, or time-consuming, but it doesn't have to be thanks to our sponsor, Fabric.
Fabric by Gerber Life is term life insurance that you can get done today. It's made for busy parents like you. It's all online. It's on your schedule, right from your couch. You could be covered in under 10 minutes with no health exam required.
If you have kids, and especially if you're young and healthy, the time to lock in a low rate is now. And even if you have life insurance through your employer, it may not offer you enough protection for your family, and it usually does not follow you if you leave your job. Fabric offers flexible, high-quality policies that fit your family and your budget, including options like $1 million in coverage for less than $1 a day.
Fabric is partnered with Gerber Life, trusted by millions of families for over 50 years. There's no risk, and they even have a 30-day money-back guarantee, so you can cancel at any time. Fabric also has free digital wills, tools to invest in your kid's future, and more, all right from your phone.
Join the thousands of parents who trust Fabric to protect their family. Apply today in just minutes at meetfabric.com/ICHclips.
Again, that's meetfabric.com/ICHclips. MEET fabric.com/ICHclips. The link is also down below in the description. Enjoy.
Let me bring it back to why I don't love individual stocks. Because I just gave you the perfect example of Apple. We got in 2008, dirt cheap. Me and buddies all threw a few $1,000s at it. When it went up threefold, I jumped out because I was excited. I made 300% in a short period of time because when the market recovered, it came back quick because everybody else caught on that, hey, Apple's a pretty good company to own. My other buddy, I think he might have held on for 4 times. But the thing is, we all dropped off. One of my buddies he still owns it.
You never got out.
So I know he might be the jack.
So what is
you know,
he?
we all
Does he
might
have a
need a jack
couple
in our
million
friend group.
bucks?
It's worth I think he put in $5,000. It's worth over $500,000 from that one holding.
Wow.
So I mean, but I'm telling you that that sounds great, but the majority of us
Are
would
gonna exit
sell.
before that.
You would sell.
This is not anything that I would recommend publicly because
Sure.
it's like you need to. This is purely logic, no emotions whatsoever.
What Jack is trying to say is that he's able to make over
Trying to.
100% a year with little downside if he keeps doing covered calls,
Mhm.
right? Because if he gets the shares called away, he could always buy a little more
Yeah, I'll
and
just
make
buy
another
100 more
3%.
shares.
But the
and then
problem
make
is,
another 3%.
there is some long term because you're getting called away on its short term holdings, so you're paying.
So yeah,
you're paying ordinary income tax
short-term
rates
capital
instead
gains,
of the
yeah.
long
That's
term
why you do it
capital
in a Roth
gains.
IRA.
I mean,
But okay, when you buy a position that actually does go down, that doesn't come back, and you made a poor purchase, you can't get those dollars back into the Roth. My opinion is if you're going to do those sort of strategies, I think the losses would likely be more valuable than sacrificing Roth dollars you will not be able to replace. Roth, you only get $7,500 in there at a time. You make one bad call that loses you 20, 30, 40 grand. That's like years and years and years of contributions you won't get back unless you have another, investment that hits. I would argue the tax drag is something I'd factor into my calculation, and I would consider it my tax.
So even QQQ, right? For example, you can sell daily call options on QQQ, and if you extrapolate that over the course of a year, it's like a 26% guaranteed return. If you were holding QQQ in your Roth IRA, why would you not guarantee a 26% return as opposed to what else? What other way you could get
if
that?
It were a guaranteed 26% rate of return that was an assured thing, why wouldn't every fund manager in the world be doing that? Why
It's
wouldn't
probably
every
a volume
investor,
thing.
right?
Well,
Because
they do covered call ETFs.
they certainly do, but not ones that are guaranteeing 26% rate of return. Because once an inefficiency exists, we operate in a capital market that adjusts pretty quickly. So yeah, inefficiencies can exist, but once inefficiencies get exploited, they then become efficient. So I'd argue, I don't think something like that has staying power, where even if you made 3.5% for a week, and if you did that for multiple weeks, I don't believe that would sustain throughout the course of a year. So I think it's illogical and irrational to assume that you could extrapolate 185% rate of return. No different than look, it's not the exact same thing, but if you go to a casino and all right, I hit red, I hit red, I hit red. Well, if I did it 100 times, think about how much money I'd make. That's not the way that it works.
I mean, you can get 0.3% daily on QQQ calls at the money, which is not too bad.
but you do realize, like you said, you make 185% or
Yeah, on Robinhood selling covered calls.
Bo's exactly right. If you could actually do that repeatable, in a guaranteed way, people would be making you'd be able to do that. And there are structures. Carter brings to us all the time these crazy structures with that you can set. He's going to be mad that I said the word crazy, but he looks at those things where they do try to play these crazy arbitrage situations, and they're interesting, but it's not something. I don't know. Maybe this is where I'm too boring.
The reason why billionaires don't do it is just because it's a strictly like volume problem. There's not enough volume.
But why not millionaires? I agree with
you. A lot
you.
of millionaires do. Yeah, I mean, a lot of people retire just doing the wheel strategy.
What's the wheel strategy?
You sell a put, and then if you get a stock put to you, then you sell a call to get it called away from you.
I've never heard of that.
I would ask you to track your time on all these things too, because I think if you add the time element to all these hobbies,
it seems like it's a hobby. This is something you enjoy. You're not doing it so much for the economic outcome. You're doing it for the enjoyment.
Because this is the same problem I have when people try to compare my index investing to like real estate investing. I'm like, yes, levered debt is going to do incredibly well compared to an index fund, but let's put into how much time you have to put into the real estate and everything. The time that's going on these strategies is worth something too.
Yeah, I sell calls on maybe 5% of my portfolio, 10% of my portfolio, transparently.
So this is just play money.
And yes, I have lost out on a lot of gains when stocks have gone up, but I've also decreased my level of loss when stocks have gone down. And if you extrapolate this as a return, or maybe expressed on an annual basis, I beat the market like consistently since I've done it.
Not counting Bloom.
Counting Bloom. I made money on Bloom. I don't understand.
Not the shares that got called away, though.
I did make money on the shares that got called away.
3%.
Yes, in a week. How was that bad? 3% in a week is 150%.
Because they're up to 100% since then.
But I'm talking compared to like the average stock market returns.
Here's what I can't wait to see, Jack, because y'all have already put yourself in a box because you said you're going to let us see your portfolio at the end of the show today. So we're going to get to look at your portfolio. You've also, because we've all gotten friendly, I kind of know what you make to a degree. we're going to judge you hard if we know how well you're doing in life. And when we look at your portfolio, we're expecting to see magical stuff because
why
otherwise,
don't we do that right now?
Because otherwise, I want to feel like
Let's hear it now.
you're growing with you have so much capacity to grow with your good income.